Hey there, money mavens. Ready to embark on a journey that could change your financial future forever? Ever heard of a book that's like the Holy Grail for investors? A book so revered that it's been guiding financial enthusiasts for decades. It's called The Intelligent Investor by Benjamin Graham. This ain't your get-rich-quick scheme, folks. Nope, it's far from that. This is the real deal, teaching you how to build wealth over the long haul. It's about patience, strategy, and understanding the market. Graham's book is like your trusty sidekick in the wild world of investing. Imagine having a mentor who's seen it all and is ready to share their wisdom. It's packed with timeless wisdom that's helped countless investors, from Wall Street bigwigs to everyday Joes like you and me. Whether you're just starting out or looking to refine your strategy, this book has something for everyone. Trust me, this book's a game changer. It's not just about making money, it's about making smart, informed decisions that stand the test of time. It's not about chasing the latest fads or trying to time the market. Those are traps that many fall into, but not you. It's about making smart, informed decisions based on solid principles. Principles that have been proven to work time and time again. So, buckle up, Buttercup, because we're about to dive into the world of the intelligent investor and learn how to invest like a pro. Get ready to transform your financial future with insights that have stood the test of time. Now, let's talk about the man himself, Benjamin Graham. This guy was a Wall Street legend, a true pioneer in the world of investing. They called him the father of value investing, and for good reason. Graham believed in the power of research and analysis. He didn't just follow the herd, he dug deep into a company's financials to find hidden gems. He was all about finding undervalued stocks, the ones that were trading for less than they were actually worth. And you know what? His methods worked. Graham's investment firm consistently outperformed the market. But here's the kicker. One of his most famous students was none other than Warren Buffett. That's right. The Oracle of Omaha himself learned from the best. One of Graham's most important principles is the margin of safety. Think of it like a safety net for your investments. See, even the best investors make mistakes. We're only human, right? But the margin of safety helps protect you from those inevitable blunders. Here's the deal. You never want to pay the full price for a stock. Always leave room for error. Buy it at a discount to its intrinsic value. That way, even if things don't go exactly as planned, you're still protected. The margin of safety is all about minimizing your downside risk. It's like having a buffer zone between your investment and potential losses. And trust me, in the volatile world of investing, that buffer can be a lifesaver. Now, let's talk about the difference between value investing and speculation. This is where a lot of people get tripped up. See, value investing is like a marathon, while speculation is like a sprint. Value investors are in it for the long haul. They're looking for solid companies with strong fundamentals. They do their research, analyze the numbers, and invest patiently, waiting for their investments to grow over time. Speculators, on the other hand, are all about the quick buck. They're chasing the latest hot stocks, trying to time the market and make a killing. But here's the thing. Speculation is risky business. It's like gambling with your hard-earned money. Section 5. Mr. Market and Market Psychology. Now, let's talk about one of Graham's most famous analogies, Mr. Market. This concept is a cornerstone of value investing and helps us understand the emotional nature of the stock market. Imagine a guy who shows up at your door every day, trying to sell you stocks. He's persistent, and his mood swings are extreme. Some days, he's euphoric, offering sky-high prices. On these days, he's overly optimistic, convinced that the market will only go up. Other days, he's downright depressed, practically giving them away. During these times, he's pessimistic, believing that the market is doomed. Mr. Market represents the emotional swings of the stock market. His behavior is erratic and unpredictable, reflecting the collective emotions of all investors. He's driven by fear and greed, just like all of us. These emotions can lead to irrational decisions, causing market volatility. But here's the key. You don't have to listen to him. In fact, you shouldn't. Ignoring Mr. Market's emotional outbursts can be one of the best strategies for a disciplined investor. See, Mr. Market's mood swings can create amazing opportunities for savvy investors. When others are driven by fear, you can find bargains. When he's feeling down, you can buy low. This is when stocks are undervalued and present great buying opportunities. And when he's feeling high, you can sell high. This is the time to take profits when stocks are overvalued. It's all about keeping your cool and not getting swept up in the hype. By staying rational and patient, you can make the most of Mr. Market's emotional swings and achieve long-term success. Section 6. Playing it safe versus taking charge. Defensive and enterprising investors. Graham understood that not all investors are created equal. He recognized the diversity in risk tolerance, financial goals, and investment knowledge among individuals. That's why he outlined two main types of investors: defensive and enterprising. Each type has its own unique approach and mindset when it comes to investing. Defensive investors are like the tortoises of the investing world. They move slowly and cautiously, ensuring that every step they take is well thought out. They're slow and steady, focused on preserving their capital and minimizing risk. Their primary goal is to protect their investments from significant losses. They're not looking to get rich quick. They're content with slow and steady growth. This approach often involves investing in bonds, blue-chip stocks, and other low-risk assets. Enterprising investors are more like hares. They are dynamic and always on the lookout for the next big opportunity. They're willing to take on more risk for the potential of higher returns. This means they might invest in startups, emerging markets, or other high-risk, high-reward opportunities. They're actively researching and selecting stocks, looking for undervalued opportunities. They spend a significant amount of time analyzing market trends and financial statements. The key is to figure out which type of investor you are. Understanding your risk tolerance and financial goals is crucial in making informed investment decisions. Are you comfortable with a hands-off approach, or do you like to be more involved? Your lifestyle and personal preferences play a significant role in determining your investment style. Once you know your investing style, you can tailor your strategy accordingly. Whether you're a defensive investor seeking stability or an enterprising investor chasing growth, aligning your strategy with your personality and goals is the key to successful investing. Section 7. Graham's enduring impact. So, why is Benjamin Graham still so relevant today? I mean, the guy wrote way back in 1949. Well, here's the thing. Human nature hasn't changed. We're still driven by the same emotions, fear and greed. And guess what? The stock market is still driven by those same emotions. That's why Graham's principles are just as valid today as they were decades ago. His teachings on value investing, margin of safety, and market psychology are timeless. Think about it. The financial world has changed a lot since 1949. We've seen bull markets, bear markets, crashes, and booms. But through it all, Graham's principles have stood the test of time. Section 8. The Intelligent Investor's Playbook. So, what are the key takeaways from it? What are the essential plays in Graham's playbook? First and foremost, be patient. Rome wasn't built in a day, and neither are fortunes. Investing is a marathon, not a sprint. Second, do your homework. Don't just buy what everyone else is buying. Research companies, analyze their financials, and understand what you're investing in. Third, be greedy when others are fearful, and fearful when others are greedy. That's classic Warren Buffett wisdom right there, straight from the Graham playbook. Section 9. Conclusion. Investing for the long haul. So there you have it, folks. The timeless wisdom of this book is your roadmap to financial success, your guide to navigating the choppy waters of the market. Remember, investing isn't about getting rich quick. It's about building wealth over the long haul, making smart decisions, and staying disciplined. So go out there, be intelligent investors, and make your money work for you.